With rural India becoming more and more urban, demand for consumer goods like washing machines, televisions, two-wheelers and cars are growing to outpace broader consumption growth rate in rural India, Sunil Subramaniam, CEO, Sundaram Mutual Fund, tells ET Now. Edited excerpts. What is your perspective on the pharma space? While most big guys have disappointed on the earnings front, we are seeing a lot of investor interest in the pharma space over the last couple of months. Where do you stand as far as the sector is concerned? We have split the entire pharma sector into three categories. One is the generic pharma drugs, second is the healthcare and related industries, and the third is the product-based companies which are there. From that perspective, we are quite bearish on generic pharma because of political risk, FDA and all of those kind of pressures. The healthcare industry is a domestic-oriented booming medical tourism business. It is a reasonable space to play out. Product-based companies are a very high-risk, high-reward bet. We need to have a very clear view. We have 5-year close-ended funds where we take those high-risk, high-reward bets, but the generic diversified fund is quite a risky space. We are underweight relative to the index in pharma. Agriculture and rural space is something that you are betting on, but there are a lot of offshoots of that. There are two-wheelers, chemicals and fertilizers, farm equipment. Which is the subsector that you are bullish on the most? Rural consumption. The move from FMCG to consumer durables to automobiles to high-end entertainment and media. We believe the change in the demographic pattern, younger population along with the rising per capita income, will help the process of urbanization, that is rural India becoming more and more urban and hence demand for consumer goods like washing machines, televisions, two-wheelers and cars growing to outpace the broader consumption growth rate in rural India. This has been aided by 3 consecutive good monsoons and the government spend. One of the key things this election year has been that election spend in rural India by political parties has shot up. To that extent, rural is like a decadal story. If you see the infrastructure spend of the government, the roads, construction, all of that is more in terms of rural India. Rural India is going to be the focus of both the infrastructure and the consumption cycle. We are very bullish, and one of the reasons is as a fund house we are overweight, as we are probably one of the few fund houses to have a dedicated rural and consumption fund, which is over 2,000 crore rupees in terms of size. Our calls on the rural sector are something that are well researched, and with a 3 to 5 year outlook, we remain bullish on the broader space there. You are so bullish on rural India just ahead of the 2019 general elections. With state elections coming up this year, crude on the boil, the fisc under threat, this is not good news for social welfare schemes. But does the government have to stay populist ahead of 2019 general elections? Yes, you have put it right. The country risk premium would go up because in this election year there will be slight slippages in the fiscal deficit, and oil price reading could lead to higher inflation, and hence the government could make the oil marketing companies absorb more of that to cool inflation. So yes, the long-term pure economic track record of the government probably is going to be a little bit challenged this year, but ultimately all that spend in the economy is going to come through as consumption. One sector which is really going to benefit is consumption, with a rural India tilt in the next 12 to 18 months. For all those factors that you mentioned, but yes, longer-term infrastructure might take a little bit of a backseat this year, but post-elections, that should come back on track. But that is bad news for your fund, right? To our fund, absolutely, that is what I was trying to point out. Absolutely. What about the oil and gas pack? Times are volatile, and the big trigger is what happens with the global crude oil prices. You see big moves on the days the global prices are down. Are funds like yours reducing their exposure to sectors which will go through these long patches of volatility? About a year ago, we took a underweight call on the energy sector and that continues. So, there is no need for us to take a fresh underweight position on that. Our position is on the wrong side in terms of the energy sector because not only is the oil price pressure there, as a power surplus country also, the prices are going to head down. So, there is pressure on that sector from an earnings perspective as well. Our short-term outlook is to remain underweight on that broader energy sector. Defensive right now, focus is on these two sectors. Sunil Subramaniam on how to tweak your portfolio ahead of 2019 elections. Sunil Subramaniam's 3 basic rules for retail investors. Su banks and no, better to stay away. Sunil Subramaniam commenting feature is disabled in your country, region.